All right, William. William says, I have been selling naked cash secured puts on various stocks for the purpose of generating income. I have been doing them on stocks I would not mind owning. William's in the same mindset as I am, and Fernando is as well. However, my real purpose is to garner income. Now, typically I go 2 to 4 weeks out, an approximate delta of 20 to 30. So as we talked before, William's probably looking for probabilities of 80 to 70 or higher, 70% or higher with that preferred delta for the cash secured put. When I have a position that goes in the money, so the stock falls and he's going to be put the stock, he says, I want to roll it out. How would I use power options to determine the best expiry date and strike price to roll to? Okay. So this wasn't directly related to the search, but what William's saying is that he has put up a search together where he's looking maybe 14 to 30 days out in time for his positions. So we'll set it to all expirations, 14 to 30, 2 to 4 weeks. Okay. And, he's looking for probably a good yield of 1.5%. Let's see if we get that. I might have to drop it down to 1. And he said he's using the delta of less than 0.3. Okay. And so in this case, I got to think reverse. 0.3 delta on a put or less, 0.3 or 0.2. I'm going to put in a filter for delta of greater than negative 0.30 because negative 0.2 is less than negative 0.3. I'm sorry, I did that reverse. I'm sorry, is a greater value than negative 0.3. We have to think in reverse with the negative signs there. I'd rather be only 0.2% down than 0.3% down, and that's what this is showing here on this view. I'll put my option volume in and open interest as well. Now, what I might look for, same thing Fernando said he might look for, and I'm sure William's looking for. He's using this to get in the stocks that he wouldn't mind owning. So I'm going to put in some criteria that I would use for a stock that I would consider buying and holding long term. I want a good average stock volume of maybe 750,000 or more. This is measured in thousands. I want a stock that's trading in an uptrend, maybe above the SMA 20, above the SMA 50. Yeah, for 2 to 4 weeks, that'll stick with the SMA 20. I may use a MACD cross signal to make sure that the MACD is positive by at least 2 or 3 days. But let's focus on the fundamentals. Based on your account size, if you're doing full cash secured, as William mentioned he's doing, you might only be putting in a criteria of maybe 5 to 200, depending on your portfolio size. Of course, it might be 500. We don't know. I'm going to look for a stock that has a positive earnings per share growth, something that's shown growth, and I will avoid earnings between now and expiration because even though I do want to own the stock, I don't want to be trapped in the surprise, just as I might be doing a covered call around an earnings where the stock suddenly falls 20 or 25%, something that could be avoided. I'm going to avoid it. And for market cap here, this is actually measured in millions. So we see here we have a guide that mid cap is usually 2,000 or greater. So let's just look for mid to large cap stocks as well. That's a basic criteria set we're going to create here. Very simple. And a lot of blackberries that came up. Penn National Gaming, that's been a really good one. But here's what I want to do. William, we're going to save this search, and we're going to call it 2 to 4 weeks out, some criteria. Okay? And the reason why I'm going to do this real quick is just to illustrate another aspect before we get directly to William's question on how can Power Options help you manage it. What I'm going to do is go to Backtest. And in any strategy, if you're on the historical level of service, you can search historically based on options that match your criteria. So we're going to go to Naked Put, Backtest. Today's the 5th, so I'm going to go to January 19th. We're going to go to the Monday following January expiration to open new positions. And we are going to use that default search 2 to 4 weeks out, some criteria. All right, so we have BB. Oh, Nicola's in there. That's probably going to be the one we're going to look at. Let's find out, William. What I'm going to do, these are all the trades that would have matched my fake default criteria if I had run this search on January 19th. Now I'm going to calculate group results. This might take a little bit longer because the system has to tabulate at the same time we're doing the dump of all of today's historical data. into the fields there. So it's got to run through the calculations as all of those tables and all those servers are doing everything else as well. All right, let's see here. Okay, Sam says, sometimes to roll naked put, it becomes a debit premium. Is it worth it? Rather put the stock to do a collar on it. In this case, stock rolls down. Yeah, we're going to take a look at that, Sam, in just a moment here as well. Okay, Fernando does add a question here. He says, why use the probability? I didn't in this case. You might have been referring to the other one, Fernando. He says, why use the probability? The probability is calculated right now. Tomorrow it could change suddenly. I think it's better to build a structure in line with your sentiment and right money management. And I agree with that, Fernando, but what I'm saying is that part of my trading plan, for the bull put credit spreads, which might actually apply to the naked put discussion here, is that I have a set schedule when I'm looking to open new trades, usually the Monday after my 3 bull puts have expired. So you get into a pattern. And so when I'm opening those positions Monday at 1 o'clock or 2 o'clock in the afternoon, I'm looking for the positions that have that probability. And sure, it could change tomorrow, but so will the delta. So will the gamma. Okay, I'm looking for the positions that historically have matched my criteria and matched my success rate on the time that I open them. That's why I use the probability. And as you know, I'm also using the technical and the fundamental data as I would as well for doing the naked puts here also. I want it hand in hand because that criteria set, as we saw, the probability matches to the delta, and that's the structure that has performed best for me over various tests and actual trading over time. All right, we've got our group results. I'm sorry. We're going to take this one. It's not, didn't do what I wanted it to. I'm sorry, folks. I was really hoping. There we go. So I'm sorry. I created a search that just off the fly there. Of course, we've been in a bullish market, but from January 19th to today, we have a 93% success rate and a 2.2% return. I was actually hoping for a larger loss. So we're going to use one of my positions. I was hoping to do something quick there. It didn't work out for me. Let's get off the back testing there. I didn't mean to create a successful search. I'm sorry. But let's go back. Let's just go into the portfolios here. And this one, everyone knows, those of you that are following me knows that that's taken a small fall again. It went up to about 61. We were talking about it last week, and I said every time that Ritchie Brothers auctioneers gets up to the price that I want to do the income method I'm looking for, it suddenly then pulls back 2 or 3 points. I was going to pull the trigger today. That's irrelevant. So let's take RBA. We're going to say that we just opened a naked put position on RBA, short put position, excuse me, RBA. And it'll be for standard expiration. So we'll look a week out, William. 2 weeks out. I'm sorry, we're 2 weeks out. And we're going to say that we sold the 60 strike put. I know it's only at 59 now. But we're going to say we sold the 60 put, 1 contract. This isn't realistic, so if you look at these numbers to verify it later, it won't be the same price. We're just faking the numbers. Let's say 0.85. So we did this when the stock was trading at 64. And now the stock is down to $59. So why did I put it into the portfolio? Why did I go this roundabout way to show William how this could help? We wanted to talk about the type of structure he was using. And now what we're going to do, I've got my position in the portfolio. Here's my naked put mixed with the other married puts. We sold it for 85 cents. It's now up to 290. I'm at a loss of 3.4% of the entire position, but my buyback cost is about 2.5 times the premium I got at 205, right? It's going to cost me a 290 to buy to close this. I'm going to take a loss of 205, which is about 2.5 times the 85 cents I initially collected. But based on the market requirement of $60, loss of 205 is only 3.4%. As you're tracking any position in the portfolio, you'll be able to, excuse me, folks, use the more information button here, go to position actions where we can, close, roll, or edit the position. But I want to go to position analysis. The position analysis tool gives me a breakdown of my current position. And you see the time value left in price, days remaining to expiration. It's below my 1% rule, meaning the stock has dropped below has reached within 1% of my short put strike price and actually dropped below it as well. So I scroll down to the bottom. We see the same numbers here that if I liquidate it right now, I'm taking a loss. It's about 3 times the premium, 2.5 times the premium we received, and a loss of 3.4% on the requirement of $60 for the cash secured put. If we hold it to expiration, the put's only going to be $99. It's just going to be intrinsic value, essentially, or $1. So the loss is much less, only $15 or 0.2% on this $60 requirement for the put strike. But as we scroll down below, we see potential rollout opportunities for this position. What is this showing me? Well, it shows us right up here what we can see. Since your put is in the money, you may be forced to buy shares of stock at 60 if you decide not to close the contract. Once you've purchased those shares, you may now turn the position into a covered call. Of course, you still keep the premium from your put right, or you could sell a covered call at the lower strikes. Now, this is showing me the covered calls here, assuming that I'm going to be exercised on the position. I'm not sure why it's not showing it. It's not just because it's slightly in the money. I think I have an answer to this, William. That it came from what Sam had mentioned a moment ago. So this is showing us converting these positions to a covered call, taking into assignment, and then, of course, selling the in-the-money calls for what our new percent return, if assigned, would be on the covered call position, and our new downside protection as well. Your question was how I can decide which one to do. Well, in this case, what we're going to be looking at is, in this, as it shows up here, of course, is what is the percent assigned value? What are your goals for the position? You originally sold a naked put where we were looking for, say, a 2% return. If I decide to go this route, allow it to be assigned and convert it to a covered call, for going out the next 30 days or 42 days after expiration, I'm probably targeting that same return and keeping that same 8 or 9% to break even, or 8 or 9% downside protection. This is a 65 call now. This is going to a covered call. This is saying it's going to a covered call at 12.4% potential assigned, but only 2% of downside protection for a 130 premium. You're doing the same thing. You're comparing the new numbers here for yield or percent to break even, or percent if assigned to downside protection, in this case, based on your trading plan, your risk threshold, the percent downside protection or percent to break even, and the yield or percent if assigned of turning it into a covered call. I think Sam's point that he brought up, where it was discussed that sometimes you don't want to, why roll down with a naked put? You wanted to own the stock anyway in this case. Why roll the put down? Take assignment, convert it to a collar position where you're selling the call as we're seeing here, but then also buying maybe an out-of-the-money 50 strike put to have controlled risk further to the downside and still have that potential 2.5% return, William, to the upside. So get the stock assigned to you and then turn it into that collar position. Okay. And I think the reason why I mentioned that normally what you'd see here is 2 things. In this case, you'd see opportunities to potentially roll down this put strike, maybe go to March to the lower strike 55 put or the 50 put. But what we're likely seeing here is what Sam mentioned, is that due to the small premium of only 85 cents that I put in and a buyback cost at 205, we might not be seeing any put options out to March or under the next 70 days rolling out to the put that can be done at a credit. They're all being done at a debit, which might not give us the proper yield on the trade. I'm going to look into that because I'm expecting to see naked put rollouts on this, but now that it's too deep in the money and in the next 30 to 40 days it didn't, or 45 days it didn't see any that could be rolled down for a credit. They were all for a debit. Why is it a bad idea to roll for a debit? What's as Sam mentioned? Let's take a look at it. And that's one of the things that's probably hard-coded into the background. So what did we do? We entered a position into the portfolio, whether you're doing a covered call, married put, collar spread, buy call, buy put, other strategies, credit spreads. You can link to that position actions and then position analysis to see potential rollout opportunities. We didn't see the rollout opportunity that we wanted. Okay, we didn't see ones that were being rolled for a credit. There's got to be something in March, I believe, but we're going to take a look. If you don't see a rollout that you expected and you want to analyze it, Simply scroll up to the top of the analysis page, click on What If Calculations. This takes us directly to the profit and loss chart for the position based on what we entered into the portfolio. You can also link to the profit and loss chart directly from the portfolio tools. But what I need to do now to simulate, are there any Februaries that I can roll for a credit now that the stock's at 59? This is a tougher one, William, I'll admit it. But it really gives us a way to show the example, because this only offers standard expirations and only 5-point spreads. We're not messing around with the dollar spread strike difference or dollar strike differences with weekly options or even 50-cent ones. This is more of an old school stock, for lack of a better term, that doesn't offer weeklies and only has 5-point spreads. So let's go to February. Now, I have to simulate closing this option first. It already shows me that it's been added. But I'm going to click that text link again for the 60 put, and now it'll be added into the second line of my entry grid. We're going to buy it back at midpoint. So that's going to be at 290, right? So what do I know now? I know that essentially I'm sitting at a debit of 205 after I close this put. That's what I need. I go to February. No, I can't roll down to the same month for a debit. I can't roll this down. Why not? Why can't I create a debit? Well, what's the point? Number one, you wanted to own the position outright anyway. Number two, if you roll for a debit, you have a no-win scenario on a naked put position. But personally, I'm with Sam. I'd probably let this get assigned to me at this point because I like the stock longer term, even though it's hit a bump in the road, and now convert it to maybe a collar or a covered call. I'd prefer a collar, same as Sam. But if your sentiment has changed for whatever happened that brought this down from, say, 64 when you open the 60 strike put, now down to 59, if your sentiment has changed on the stock, I'd get out of the naked put for just the loss rather than try to roll it down. Okay, but let's look at March. Were there March options available that we can get for 205 that are out of the money? No. You could do the 60 at the money right now, but that would leave you in the same scenario where we're slightly in the money. You roll down to the 55 put in this case. Remember, our debit's 205, wasn't it? Yeah, after buying it back for 290, the debit was 205. We took in 85, had to buy it back for 290. We're 205 in the hole. 55 for March doesn't satisfy it. Next available cycle, that's the problem. Next available cycle is June. Once we cross February expiration, we'll have April's available. So June here, hey, that would give it to it. This would be one you could roll to, but it's another 133 days out. If I'm still bullish for that amount of time, I might consider now, William, just taking the stock at assignment for the 60 strike, converting it to the covered call or the married put you wanted because you wanted to own the stock outright. So, direct answer to your question, after I went through all that search, I'm sorry, after I went to the back test and I only had one losing position that wasn't in the money, where the stock had fallen below the put strike price from January 19th, the search on the fly that apparently looks successful. When you go to position actions and position analysis, if you can roll to naked puts, and I think what we look for is to roll to naked puts, roll your existing naked put if it's in the money, to maybe less than 70, maybe less than 75 days out in time, and obviously roll for a credit so the percent yield is positive. Otherwise, if you're rolling for a debit, as we saw just now with DAR, rolling down to February didn't give us a credit. Rolling down to March didn't give us a credit. It's a no-win naked put. Maybe just take the stock if you're still bullish on the position. Let's see if we can evaluate some rollouts. We know that the buyback cost is 290. So let's say I actually received 265 for this put when I sold it, and rerun the analysis for you. There you go. Now, you see both. Here's your covered calls. Here's the positive ones. This is why they didn't show it first. We illustrated that with the custom spread tool, the profit and loss chart. But if I did get a good enough premium, we took in 265. Our buyback cost now is 290. So we're only down 25 cents. We could roll down to the March 55 put, March 35 put. That looks a little bit odd. That's maybe a high midpoint price in that case. But here we could, roll down to the 55 put. 4 points out of the money, not quite 10%, but pretty good. Get a new net credit of a new premium of 173. So my adjusted net credit, factoring in the 25 cents I lost for the buyback plus the new 173, gives us a 148 premium, 2.7% adjusted naked yield for the next, remember, 42 days out to March expiration. Oh, that's the annual, I'm sorry. And the break even is still 9.3%. So what you're doing here now on this table as you're analyzing the rollout opportunities is I'm going to extend it from 14 days to 42 days. Am I increasing my potential return, returning the position from a loss to a gain in this case, by rolling it out? Does the new naked yield return for these rollouts match my trading plan for this strategy? And is my percent break even still within the reasonable range that I'm looking for this portion of my portfolio, my trading plan for the naked puts? That's the analysis I'm looking for. And right now we saw, well, it's not a fair assessment. Right now we're at a loss of 0.4% because we faked the higher premium to show you these rollout opportunities as they would appear if a credit can be achieved, because you don't want to roll the naked put for a debit. Might as well, as Sam said, and I said, just let the stock be put to you, convert it to a collar or another protected position or a covered call if that's your choice. But when you see the rollout opportunities, does moving from a 0.2% loss right now, 0.4%, excuse me, liquidation loss right now to 2.7%, going from 14 to 42 days, does this number match my trading plan for this strategy portion of my portfolio? That's the answer. Okay, to me, that's the answer. When you see, if I saw further ones out here for rolling the put, which we didn't see because it's too far out, but if I saw the Junes or Julys, I believe it was, we saw the Julys out here 133 days, the return might only be 5%. It's a 5% naked yield for 133 days, matching my trading plan, William, and trading goals for the naked put structure in my portfolio. No, probably not for me personally. I know it's 5%, and we're talking about, 4 to 4.5 months there. So, I mean, yeah, it's about 1% yield per month, but I might be looking, as I mentioned, for around a 1.5 to 2.5% yield with this strategy, personally, every 30 days. This one would be a little bit below that if it showed up, so I'm not sure if I'd do it. But that's what we look to do. All right, so that's how the Power Options tools can help you, analyzing the rollout opportunities and comparing which potential adjustment, which, by the way, as you can see, all the math is done for you. What is my new adjusted net credit, my new naked yield as a cash secured naked put, and my new percent to break even if I do roll down to the March 55. By the way, it's great to see things numerically. Some of us, I know many of you, would prefer, I can't do it that way. I'm sorry. I got to go back. Once I make an adjustment on that page, I can't do the feature that I wanted to show. So let's take our covered calls again that we had. Again, it's great to see things numerically, but when you see a rollout opportunity, you can click on Simulate Trade, and now you've got the side-by-side comparison, the original position in red and the new position, which is not showing the right, it's showing the right one. I know why it's doing it there. It's not showing the right premium on that position there, and that's fine. So this one at bid price would only give me a 1.2, will give me a 1.2% loss, but at midpoint here, we'd be looking at a positive percent return if assigned in that case. So that's why that subtle diff, it didn't look right to me there in that scenario, why it's showing a negative for the covered call. It should be a positive. I'm going to take a look at that as well. But I just wanted to show you that you can, anytime you see rollout opportunity, you can go to Simulate Trade, compare it graphically as well as the numerics that show up here. But that's my first comparison, is looking at what is my new return from this roll, my new protection or percent to break even if I perform this roll, and does this new return for the time frame match my trading plan for this strategy, my portfolio. That's how I decide which is the best strike to roll to. Based on my trading plan, what the new return, new protection would be if I perform that roll, William. That's what I look for in that case. While we're here in the portfolio, I'll answer this question real quick from Fernando. Fernando says, in Power Options, is there a way to see how much theta in dollar per day the structure is gain or loss? Well, when you go to the Greeks view in the portfolio for tracking your positions, you can see the theta here of each one and a summation of your total portfolio, the delta summation of your total portfolio, gamma, theta, position theta is one that's there overall as well. The position theta, excuse me, is the rate at which the option loses value as time passes. The option with a theta of 0.04 will lose 0.04 in value for each passing day. So I think the position theta is what you're looking for, Fernando. If you go into this view here for the Greeks view, excuse me, when you're underneath the portfolio and tracking your positions. I think it's position theta that you're looking for, Fernando. But check it out there and let me know, okay, if that met your needs to your question.